Welcome back to Explain the Charts. Today, September 21st, 2025, we're putting the spotlight on one of the most actively traded currency pairs, USDJPY. The market is currently navigating a fascinating landscape shaped by diverging monetary policies from the U.S. Federal Reserve and the Bank of Japan. As we look at the daily chart for USDJPY, encompassing data from May 2024 through September 2025, a crucial theme emerges: the contrasting approaches of these two central banks. The Federal Reserve has been in an easing cycle, having cut interest rates by 25 basis points as its first reduction since December 2024, with expectations of further cuts. Conversely, the Bank of Japan, while largely holding steady, has shown increasing hawkish pressure with dissents from policymakers advocating for rate hikes, creating a potential for future tightening. FX Street analysts, in their 2025 forecast, predicted a bearish start for USDJPY, driven by trade war fears and anticipated Fed rate cuts, aligning with some of the yen's strength we've observed. However, they also anticipate a bullish turnaround later in 2025, suggesting that a more hawkish Fed and potential BoJ inaction could lead to further gains, implying a long-term uptrend for the pair. Let's narrow our focus on the daily chart to the period between July 2024 and September 2025 to examine how these fundamental shifts have played out. We can clearly see significant volatility during this period, with notable pullbacks in July and August 2024. The sharp drop on July 11th, from highs around 161.76 to lows of 157.408, aligns with the news of traders betting on the yen ahead of BoJ, Fed decisions, and the Fed's initial rate cut. Further declines in late July and early August pushed the pair to lows around 145.276, reinforcing the market's reaction to expectations of U.S. monetary easing and hawkish signals from the BoJ. Subsequently, USDJPY found strong support and began consolidating, often described as being stuck in a tight 147 to 149 corridor by sources like Trading News. This consolidation reflects the market's wait-and-see approach, as participants weigh the implications of both central banks' upcoming policy decisions. The 200-day simple moving average, around 152.00/152.10, has often been a battleground for the pair, with movements above reigniting optimism and declines considerably below it indicating bearish pressure. Now let's switch to the 1-hour chart, focusing on the recent price action from early September 2025, which provides a clearer picture of the ongoing range-bound trading. The candles show that despite some intraday fluctuations, USDJPY has largely remained confined within a specific range, echoing the sentiment of US dollar to Japanese yen price stuck at 147.6 with Fed and BoJ decisions in focus. We can observe periods where buying interest emerges around 147.00, forming a nascent support level, and resistance building up as the pair approaches 148.50. The overall flatness of momentum indicators like the RSI and MACD, as noted in the news, is evident here, confirming the lack of a strong directional bias in the short term. These recent candles show cautious trading as market participants anticipate the pivotal Fed and BoJ meetings scheduled for this week. A breakout from this tight range on the hourly chart would signal a significant shift driven by the actual policy outcomes. Zooming further into the 15-minute chart, specifically from September 16th to September 19th, 2025, we get a granular view of this tight consolidation. Notice how the price has been meticulously adhering to a narrow channel, fluctuating mostly between 146.30 and 148.20. The recent close around 147.935 for September 19th on the daily chart falls squarely within this congested zone, confirming the immediate neutrality. On this time frame, we can see subtle attempts by bears to push the price below 146.50, but these have been quickly rejected, leading to swift recoveries. Conversely, rallies towards 149.00 have met strong resistance, indicating a clear ceiling for the pair in the very short term. This dynamic reinforces the idea that significant movement requires a powerful catalyst, likely from central bank announcements. The flat momentum on these shorter timeframes highlights the market's indecision and the absence of strong buying or selling pressure, making it a high-alert zone for breakout traders. Returning to the daily chart, let's re-emphasize the broader technical picture and key price levels for both short and long-term trading decisions. The range of 147.00 to 149.00 is a critical short-term corridor, with the 50-day exponential moving average at 146.20 offering immediate support if bearish pressure increases. Below this, the psychological level of 146.00 and then 144.00 become the next significant support zones, a collapse towards which is likely if the Fed adopts a significantly dovish stance alongside hints of BoJ tightening. On the upside, immediate resistance is found at the 200-day EMA around 149.35, followed by the formidable 151.00 level. A decisive break above 149.00 could signal the start of a new bullish trend, potentially testing higher resistance levels like 156.97 and even 161.81. As indicated by FX long-term technical analysis. It's worth noting that the long-term forecast still points to an uptrend for 2025, supported by the pair trading above its 50-week simple moving average. To recap, USDJPY remains at a pivotal juncture, currently oscillating around the 147 to 149 range as of September 21, 2025, with a slight bearish bias noted by some analysts. Key support levels to watch are 147.00 and the 50-day EMA at 146.20. A break below this could open the path to 144.00, which has a moderate likelihood, around 40%, if the Fed signals more aggressive rate cuts and the BoJ maintains its hawkish tone. Conversely, resistance lies at 149.00 and the 200-day EMA at 149.35. A decisive breakout above these levels could lead to a test of 151.00, with a moderate likelihood, around 35%, if the Fed opts for a more gradual easing cycle and the BoJ's guidance remains cautious or vague. The likelihood of a significant upward move towards FX higher long-term resistance levels like 156.97 and 161.81 for late 2025 is lower in the immediate short term but still plausible, around 25%, if global trade stabilizes and the BoJ significantly disappoints on policy action while the Fed turns more hawkish later in the year. Traders should closely monitor the upcoming Federal Reserve and Bank of Japan interest rate decisions, as these are the primary catalysts for a definitive breakout. Additionally, any unexpected shifts in U.S. economic data, like retail sales or manufacturing indices, or Japanese political developments following Prime Minister Ishiba's resignation, could also trigger significant volatility. For now, vigilance is key and close monitoring of price action around these critical support and resistance levels is paramount for making informed trading decisions. Thank you for tuning in to Explain the Charts.